Sonny, there's only one word to describe what's happening, and that is panic.
Well, the law of gravity hit Wall Street today, and financial markets around the world, for that matter, as stock prices plunged even more than they did on Black Tuesday of 1929.
So it's 30 years today that the US stock market saw its biggest one-day percentage decline in history. No single-day drop had ever come close in the approximately 100 years before and in the 30 years since. Prior to 1987, the biggest one-day falls happened in October 1929 on back-to-back days. October 1987 was almost twice as bad as either of those 2 days in October 1929. And of course, since nothing like that had ever happened since 1929, there were fears of another Great Depression in 1987. But there was no Great Depression, not even a recession. The unemployment rate was 6% in 1987 and kept falling to 5.2% by 1989, and by that time the stock market had fully recovered and was less than halfway to completing the greatest ever secular bull market in history. Now, before people jump to conclusions, no, I'm not going to make an analogy to today's market. I'm not calling for an imminent 1987 type crash, but I thought it would be a good time to do a brief market update. So not much has changed in the couple of months since I last commented on the US stock market, except that it has pushed higher and therefore has become even more overvalued. Here's a chart of Robert Shiller's famed cyclically adjusted PE ratio, currently sitting at just over 31 times, 1929 and 2000 being the only occasions when the stock market was even more overvalued. John Hussman has adjusted the CAPE ratio to take account of the historically high profit margins of today. And when you do that, the CAPE is at its highest point in history. And why would you adjust for profit margins? Well, because they are one of the most mean reverting series in finance and are unlikely to stay at the current high levels. In fact, they've already started to come down in line with rising unit labour costs. And note that this valuation method devised by Hussman has a correlation of approximately 0.9 with actual subsequent market returns. Another metric which displays the same level of correlation with market returns is the median price to revenue multiple. As can be seen here, today's level is far in excess of anything we've seen ever before. How could it be so much higher than 2000, you ask? Well, the overvaluation in 2000 was concentrated in mostly large cap tech stocks. Today's overvaluation is across the board, which means in the event of a broad market decline, there will be no place to hide. Now, probably the most common argument used to justify high stock valuations is low interest rates. Low interest rates backed by a Federal Reserve willing to undertake quantitative easing at the first sign of trouble is probably the current cycle's "this time is different" narrative. Remember, in 2000, the "this time is different" narrative was the internet era, in which old methods of valuing stocks no longer applied. It was all about eyeballs and view counts. Well, it turned out that the old methods did actually matter after all. Then in 2007, it was house prices always go up. But of course, it turns out that they don't. And anyone who'd studied the history of US house prices would have known that. Despite Warren Buffett's favourite indicator of market cap to GDP being egregiously overvalued, Warren Buffett has recently bought into the "this time is different" narrative, stating earlier this month that valuations make sense with interest rates where they are. And maybe he's right. After all, he's Warren Buffett, one of the most successful investors of all time. Here's another chart produced by Hussman showing that indeed low levels of interest rates are associated with high valuations, measured here by the aforementioned adjusted CAPE ratio, the red dot representing where we are now. Note the third variable, actual subsequent market returns over a 12-year period. Whilst low interest rates do correlate with higher valuations, they're also correlated with low and sometimes even negative market returns. As Hussman notes, while it's true that lower interest rates have generally been associated with higher market valuations, particularly during the inflation-deflation cycle from 1970 until the late 1990s, those low interest rates did absolutely nothing to mitigate the dismal market returns that actually followed extreme market valuations. Interest rates can certainly contribute to the emergence of rich valuations, but once those valuations are set, so are the prospects for subsequent market returns. It's tempting to imagine that if interest rates remain low even 10 to 12 years from now, everything will work out somehow. Unfortunately, the fact is that interest rates at the end of any 10 to 12 year period are strongly correlated with the economic growth rate over that period itself. So whatever gains are not taken away by reversion of valuations would instead be taken away by weak interim growth. And weak growth is almost a certain proposition over the coming decade, given current trends. Now, just another note on unusual market signals. Take a look at this chart of European junk bond yields, which are now yielding less than the 10-year US Treasury, whilst the credit quality of those junk bonds is deteriorating. Of course, it helps that the European Central Bank continues its program of quantitative easing, but in what universe does this make sense? The answer is probably in a this time is different type of universe. Anyway, I'll leave you with some words of wisdom from Nassim Nicholas Taleb, author of Fooled by Randomness, The Black Swan, and more recently, Anti-Fragile, who was one of the few that made a killing during the meltdown on Black Monday in 1987. This interview was posted on Bloomberg in the last few days, specifically on the topic of the 1987 crash. Link to the full interview in the description.
So you learned some important lessons on Black Monday. What did everybody else not learn?
That these events are not outliers. They're a regular part of the system. See, so and there's a first mistake people made with Black Monday. Before Black Monday, those who wanted to do risk management went to the past and looked for the worst deviation, and it was something like 10%. So you had Black Monday, now, which was 2.2 times whatever the deviation. Now what do they do when they backtest? To Black Monday. I mean, don't you recurse? So there was a new field new field like 30, 40 years old field in science called extreme value theory. And it started with the Dutch who wanted to build to protect themselves. So how high should our protection be, right? So do you protect to the worst past? Of course not. It's logical that it can get worse, right? So you take the worst past and you multiply it by 1.5 or some factor, and you live with it. Yes.
If that's the case, why is it that people still continue to use models like Black-Scholes?
Because they don't pay for their losses. Someone else pays for the losses.